Welcome back. Today, we're diving deep into high yield investing, focusing on business development companies or BDCs. We'll explore what these investments are, their pros and cons, and make sure you stay until the end of the video where I'll do a deep dive into my own portfolio and my BDC holdings. If you're looking to boost your income with smart investments, stay tuned. Okay, so what are BDCs anyway? BDCs are publicly traded companies that provide capital to small and mid-sized businesses. This capital often is in the form of loans or equity. They step in where traditional loans might not be an option, seeking for higher returns. These businesses can be startup, mid-stage businesses, and in some cases, even high-growth, publicly traded companies. Each of these BDCs will have their own target profile for companies that they want to invest in and to keep within their portfolios. Now, if you're wondering what kind of loans these are, and if you can get one for your business, well, BDCs mainly invest in 5 types of loans, which allows for diverse income streams and potential capital appreciation. Let's break down those loans. So the first type of loan is secured debt. This is a loan that is backed by collateral like property, other assets, cars, things like that, even inventory. And if the borrower can't pay back the loan, the lender, in this case the BDC, can take the collateral to recover some or all of the money. This type of investment is generally considered safe because there's something valuable backing the loan. Okay, next, senior loans. These are loans that get paid back first if the borrower runs into financial trouble. Because they are first in line for repayment, they're usually less risky than other types of debt, like credit cards or any other unsecured loans. Next is subordinate loans. These are loans that get paid back after the senior loans if a borrower defaults. They're riskier because there's a higher chance that they won't get repaid in full if the borrower goes bankrupt or something major happens like that. But they usually offer higher interest rates to compensate for some of that risk. So many BDCs are willing to do subordinate loans. Okay, and next is unsecured debt. This type of debt isn't backed by any collateral. If the borrower can't pay back the loan, the lender doesn't have a specific asset that they can take to make their money back. This makes unsecured debt much riskier for BDCs, but it can also offer high returns because of that increased risk in the form of interest rates. You know that credit card in your wallet? That is considered unsecured. What's the interest rate on one of those? Usually 25 to 30%. Insane. That's what unsecured debt is. And then finally, equity. This means owning part of the company itself. So if the company grows and becomes more valuable, the value of this equity can also go up, potentially providing big gains for investors. But owning equity also means sharing in the risk of that company. If it doesn't perform well, the equity doesn't do well. This is essentially like owning stock or owning a percentage of the business. So some of the pros and cons of BDCs. High yields. BDCs are required to distribute at least 90% of their taxable income to shareholders, which usually leads to very attractive dividend yields. They also have access to private markets. So investing in BDCs offer exposures to private companies and niche markets, which can give you diversification that's hard to get otherwise. Simply put, you can invest in companies that aren't yet publicly traded through the BDC investments. And some of the cons, they're definitely higher risk. BDCs lend to smaller, potentially unstable companies, which means that they're at higher risk to default. Do you remember Silicon Valley Bank? Remember that debacle? Not only did investors lose out, but many of the companies that had loans or accounts with that SVP no longer had access to their money. Secondly, interest rate sensitivity. BDCs are sensitive to interest rate changes, which can impact their borrowing costs and profitability. So with the market right now being what it is, and the Fed toying with interest rates, this can have a big impact on BDCs' ability to grow, loan, and profit. With all that said, you might ask, why even risk investing in BDCs? High yield potential for one reason. BDCs offer high dividend yields, often more than traditional stocks or high yield bonds. BDCs dividends can range from 4% all the way up to 20+% depending on the business. Not saying that 20% yields are always the way to go. Those BDCs usually have issues of their own because their dividends are so high. There's usually something underneath that's causing that, so definitely do your research. Another pro to investing in BDCs, you can generate regular income. High yields and frequent dividend payments, whether they're monthly or quarterly, can provide you with consistent cash flow for living or reinvesting into other things. They can also be a hedge against inflation. Some BDCs with floating rate debt benefit from rising interest rates, which can offer you a potential hedge against inflation, right? When interest rates go up or down, these BDCs can adjust accordingly. But some of the cons are volatility. BDCs can definitely be more volatile than traditional stocks, especially during market downturns. Plus, there's also regulatory risks. BDCs are subject to regulatory changes that could affect their tax status or distribution requirements. If you get used to a monthly or quarterly income, that can change with interest rates or even government policy changes. So Comment down below if you're invested in BDCs and what are some of your favorite investments if you are. Okay, as promised, here's an in-depth look into which BDCs I'm invested in and some of the performance history around them. Remember, this is not financial advice. I'm just a dude on YouTube sharing some of the things that I do, right? Okay, number one, my biggest holding is Hercules Capital, ticker symbol HTGC. This makes up about 6.2% of my overall portfolio. They specialize in lending to high growth companies in technology, life sciences, and sustainable sectors. Their current dividend yield as of this recording is 10.4%. They pay quarterly, and the last ex-dividend date was August 13th, 2024. Some of the pros is they focus on high growth sectors with significant upside potential, like tech, which if you follow me, you know I love. They have a strong history of dividend growth, and they offer a stable and increasing income stream. Some of the cons for HTGC, they have a high payout ratio of 105.5%, which could be concerning if their earnings don't always improve. Also, their investments are more volatile and sensitive to economic downturns. It's the flip side of tech, right? Tech, high growth, sensitive to downturns. All right, next, number two is Ellington Financial, ticker symbol EFC. They make up about 5.7% of my portfolio. Now, they're a mortgage REIT focused on residential and commercial mortgage-backed securities. So this is a fuzzy one. They're considered more of a REIT, but they act like a BDC since they focus mostly on loans on real estate. Instead of something like Realty Income, which they own the real estate and manage it, EFC handles the loans for that real estate. Okay, current dividend yield as of this recording is 14.5%, and they distribute monthly if that's your dig. Some of the pros, they have diversified exposure to both residential and commercial mortgages, and their monthly dividends provide lots of consistent monthly income for investors. Okay, some cons, sensitive to interest rate changes because they are in real estate. So as interest rates drop or go up or go down, they're sensitive to that. And they also pose potential credit risks from these underlying mortgages. If the mortgage defaults, then they have to go through a lengthy foreclosure process. And even then, there's no guarantee that they'll get all their money back, right? Just like any other real estate investment. Next, Crescent Capital, ticker symbol CCAP. And they make up only 1.2% of my portfolio. They focus on senior secured loans. And their current dividend yield as of this recording is 10%, and they distribute in quarterly payments. Some of the pros here, they focus on senior secured loans, which offer some protection in case of default. So remember, those are the ones that get paid back first if something happens with a business. And they have stable quarterly dividends. So they've been paying consistently each quarter. Some of the cons they have is they tend to have lower yield compared to some of their peers. So 10% in the grand scheme of things is pretty high, but compared to other BDCs, it can be considered low. And there's economic sensitivity that could affect their portfolio of companies, again, with the market. Okay, and the fourth one we have is Rhythm Capital, ticker symbol RITM. They make up 2.9% of my portfolio, and I know this isn't in numerical order, but they are more similar to EFC, which is a diversified REIT with exposure to mortgage servicing rights and other financial assets. But again, they act like a BDC since they manage loans against real estate. Their current dividend yield as of this recording is 11%, and they make payments quarterly. Some of the things I like about this Rhythm is their diverse investments. It reduces the risk, and they offer multiple income streams. Also, their higher yield is appealing for income investors like me. And some of the things I don't like is they have a complex business model which can carry some risk. And their performance, again, is sensitive to rising or falling interest rates. But yeah, the more interest rates go up, the less profit they have. And then finally, Ellington Residential Mortgage REIT, ticker symbol EARN, which I know this is selling a REIT, but again, they perform like a BDC, and this makes up 0.4% of my portfolio. And again, they're focused on residential mortgage-backed securities. The current dividend yield for this is 12%, and they pay monthly. Things I like is high yield. They have a pretty high dividend yield, and they pay monthly, which for me is great because I usually reinvest. I'll either reinvest into the stock itself, or I'll use that to fund other positions. Some of the cons, they're concentrated in residential mortgages, which increase their sensitivity again to market conditions, interest rates. Interest rates go up, profits go down. And they have more volatility compared to other diversified REITs or BDCs. So there's a little bit of a look into my portfolio and some of the things to consider before you invest in these types of BDCs. There's definitely market sensitivity. Both BDCs and REITs are affected by broader market movements and the economic cycles, with significant value drops during these economic downturns. There's also a lot of regulatory risks. Changes in tax laws or regulations that can impact their operations and effectively their distribution of dividends. Next is the management quality of these funds. The success of these investments often rely on the quality and expertise of their management teams. Picking the right companies to invest in is not easy. So if the management teams are good, great. But if they're not, performance may vary. So how do you know what BDC to invest in? Great question. And the answer to that is it depends. I know you probably don't like it when that happens, but it depends on a couple of things. So the first is your investment goals and risk tolerance. What is your comfort with risk and what are your income needs? Decide whether you prefer stable payouts or if you're willing to accept higher risks for greater returns. And the second is research and analysis. Perform your own due diligence on performance history, the management team quality, and investment strategy to make sure you're in alignment with your financial goals. You don't want to go all in on these stocks if you're not informed of the pros and cons of each specific BDC. So please, I can't reiterate more. Do your research. Don't just invest because I'm invested or someone else on YouTube told you to. And remember, this is a high-level overview. Don't just do what I do. Do some research, look at performance, and then make that decision for yourself. So, BDCs, they can definitely enhance your portfolio with high yields and diversification. Definitely understand your risk and do your homework. Those are the key things to making any wise investments. A lot of the stocks can offer great growth while paying you dividends along the way, but you have to know what you're getting into. There are definitely pros and cons and definitely lots of risks involved. If you found this video helpful, don't forget to like, share, subscribe for more investing insights. Thanks for watching. Happy investing. Take care, and I'll see you next time.